How to buy a rental property before the end of the year to help you save on your taxes. That's today's video. Let's dive in. Hi there, I'm Clayton Morris. I'm the founder of Morris Invest. We are a turnkey property provider, one of the largest in the country. And today we're going to talk about how to save on your taxes before the end of the year by buying a rental property. My office gets very, very busy towards the end of the year when the investors that we work with basically get a call from their accountant saying, hey, you're going to owe the IRS $40,000. You may want to consider buying another rental property, or better put that to use. So we get a lot of phone calls from investors that want to pick up properties before the end of the year. Now that's probably not good accounting on their part, but nevertheless, buying rental real estate is a fantastic way, probably the number one way to mitigate your overall tax burden in this country. It truly is phenomenal. And the tax code in this country, in the United States, was specifically written to encourage entrepreneurship, and rental real estate ownership is a fantastic way to do that. You know, just about every member of Congress owns real estate. There's a reason they own real estate, because the tax code rewards them. Okay, let's dive into some of the reasons why. Number one, deductions. Of course, with owning rental property and all the expenses that go with it when you're doing a rehab on a property or maintenance or upkeep, even the printer that you're buying to print out the leases for your tenants, if you manage and do all these things yourself, that is an expense, right? So the deductions that you get to claim. Now, I presume that you probably, if you've watched any of my videos for a number of times, you know that you should be buying these properties in a legal entity, right? An LLC or an S Corp, whatever your accountant tells you to do. But the deductions that you then get to apply because you own it as a business and you own your rental properties inside of a business, those things are deductions. Perhaps you have a home office that you use to manage your properties. You and your wife sit down, you've got a home office that you can close the door, you work on your spreadsheets for your rental properties. You get to claim a portion of your home office on your annual taxes. So that's another great way to take advantage of this. Number two is depreciation. It's pretty simple. You simply get to depreciate the value of the property over the course of 27.5 years. That's what the federal government says you can do. Now, I've got another video where I deep dive depreciation. You can click on that right here in the little card that pops up. Also in the description below this video. But for now, just know that when you spend $30,000, $40,000, $50,000 on a property, the value of that property does not have to be hit for your taxes all at once. You can claim that value depreciated over a number of years. Basically, the government's saying, hey, that asset is deteriorating. You know, there are, like a car, right? There, wear and tear. And the government is recognizing that that property is going to have wear and tear. Well, you get to claim that against the rental income that you're bringing in, which is a great way to mitigate your overall tax burden by owning rental property. Depreciation. And there's some great strategies and tactics on how to use depreciation, and there's some really high-level ninja tricks on how to use depreciation if you own commercial property or multiple properties. We'll deep dive that a little bit later, but again, we can deep dive that if you check out my other video on depreciation. Number three on the list, another great way to mitigate your tax burden if you're selling a house this tax year, is to use what's called a 1031 exchange. Now, this is a fabulous way of being able to take the money, the profit that you would get from the sale of a property. So let's say you sell a property and your profit is going to be $300,000. Well, you don't have to pay capital gains taxes on that in this calendar year. Well, the IRS gives you the option of a 1031 exchange, which lets you then roll that profit into other property, into like and kind assets, as they say. So you could take that $300,000 and you could potentially buy 6, maybe 8 rental properties with that amount. Maybe you buy, each of them are $50,000. Anyway, it has to be like and kind, and it also then can't be less than the $300,000 in value. Roll that into those properties, and then you don't have to pay the capital gains. This is a fantastic way of exploding your rental portfolio, number one, because now you went from 1 property to 6 properties and the overall rent roll that you'll be able to achieve is going to increase as well by doing a 1031 exchange. So it's a great way of mitigating your overall tax burden. And one of the biggest and best ways to really mitigate your overall tax burden with rental real estate is number 4 on my list, and it is treating it as a capital expense. The bottom line is, when you're purchasing a rental property, it is a capital expense for your business, right? It is not a business expense, so it's not the same thing. But the capital expense, you then get to depreciate over that 27.5 years. Just like buying a big tractor for your company that is going to be depreciated. It is an asset for your company, and therefore it offsets your overall income and other income sources from your company. A big capital expense, especially if you've got to make $20,000 worth of improvements on that particular house, that is a huge capital expense. And this is why, my friends, really smart real estate investors who taught me this a number of years ago, the rule is never stop buying rental properties. Buy until you die. Why? Because the moment you stop buying rental properties, now you start to pay taxes on all of that rental income. If you stop buying properties to mitigate that, now all you have is income tax, rental income coming in, and nothing to offset it with the purchase of new property. Again, I'm not an accountant, I'm not a lawyer, so seek consultation from your accountants or lawyers on all of this. But this is the way that we do it, and this is why the tax code is so great for real estate investors. You can mitigate your overall tax burden if you understand the tax code and if you work with an accountant who understands real estate. There's really nothing better than real estate to crush your taxes. I'm Clayton Morris. Please subscribe to my channel if you already are not a subscriber. Please, we publish videos multiple times a week. Just click on the little subscribe button right here on this video, and you can check out all the resources in the description below and some of the other videos we talked about here today. We'll see you back here again on another video, everyone. Go out there and take action and become a real estate investor.